Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's CFP certified financial planner Tim Stearns, president and founder of TJ Stearns Inc., providing us clarity in the financial world, helping us achieve our financial, investment, and retirement goals. He is your resource, ladies and gentlemen. And Tim, we always appreciate the guidance and insight that you bring to the radio airwaves here and across Chicagoland.
Peter, thanks again for having me.
Always a pleasure, Tim. We appreciate the time that you spend to make sure that those that are serious about their financial futures across Chicagoland have the information to make well thought through and informed decisions. That's always been the goal of the program here on Protect and Grow, and a goal that you continue with the valuable ability and opportunity that you provide for savers and investors to come in, complete that plan, get the plan put together, that Protect and Grow plan that you help people put together.
We love doing it, Peter, and I find that a lot of people are in need of that. I'd say 9 out of 10 Americans don't have any plan whatsoever, and they're just hoping for things in retirement, and we don't do that. We try to help them get through a 30-plus year retirement and make sure that it's successful.
Well, Tim, as the weather has been heating up here in the throes of the summer months, I know that there are a lot of hot financial topics that are on the minds of savers and investors, the things that we're talking about around the dinner table. We're hearing about it on the news. It's the water cooler talk at work. And a lot of these are concerns that are on people's minds. That's what we're hearing a lot about. Maybe some opportunities out there with things like the meme stocks and cryptocurrencies and Bitcoins. Those are all also obviously hot topics. And maybe we'll talk a little bit about that. But I thought we would spend some time today, Tim, and you and I discussed talking about these news of the moment, hot topics in the financial world, the things that we are hearing so much about, and talk about how savers and investors need to internalize and interpret these things to actually make use of them in their planning.
Well, I mean, the number one thing that I'll lead off with as far as being hot is the stock market. And, it's a little frightening that the market is still going, especially after what we've been through over this past year. A lot of that has to do with the Fed doing, however you want to call it, but it's quantitative easing again. And, they're printing money at a rapid rate, and that's causing the markets to keep going up. I just wonder when the other foot, or the other shoe will drop, I guess I should say. It doesn't seem real to me. And that's one of the reasons that I think, having stop losses in different products are absolutely huge. When we work with people's finances, with money and that type of thing, we try to have stop losses on anything we can, just for the sake of, trying to stop the bleeding. If March 2020 happens all over again, then we're at the ready.
Well, Tim, as I understand it, a stop loss allows us to take advantage if the market is growing, but it kind of puts in place a line in the sand that if the market takes a downturn, this is the point where we feel comfortable, the maximum amount we would like to lose. And if we reach that point, we kind of pull out and move to cash. That is what a stop loss is, and why in a white hot stock market, that might be something valuable for savers and investors, correct?
Well, if you look at the past history over the past 100 years, right, of the market, if the market slips down about 5%, chances are it's going to continue to go downward. So that is another reason that we tell people, let's not be greedy here. Let's make sure that we put in a stop loss. They worry, well, what if I miss out on whatever? Well, you've had 12 years of a run up. How much is enough? And I know last March, I've talked to people and they're like, oh my Lord, if that ever happens again, I'm never going to, I'll stop losses in. And then here we are, insanity is the, by definition, is doing same thing over and over and expecting different results. I mean, you have to get real out there and realize that all good things do come to an end. I'm really glad it's been a 12-year bull market, but let's be realistic.
But there is that FOMO in our acronym loving society, the fear of missing out. And because we're hearing so much about this white hot stock market and how good it's been, a lot of people may be jumping in or taking unnecessary risk or exposing more of their total portfolio to the market than what is truly appropriate at different stages in our life. And that's one of the things that protect and grow plan helps us to understand, to quantify, and to address in the planning is what is the true risk exposure that we have? Does it meet and match with your risk tolerance, ladies and gentlemen? And I mentioned the fact that Tim Stearns does offer the opportunity for you to get a plan. He will help you put that together with the help and the guidance and the perspective of a certified financial planner, a CFP, and tax and legal professionals there in the office at TJ Stearns as well. If you would like to take advantage of that opportunity to get your plan put together, or even if you have the tools or the plan in place to double check it and give yourself some reassurance, pick up the phone and give Tim Stearns, TJ Stearns Inc. a call, 800-640-2256. That's 800-640-2256. 800-640-2256. 800-640-2256, or you can go online, tjstearns.com, tjstearns.com. Tim, do you worry that people are enthusiastic and enthralled by this hot stock market and maybe taking that unnecessary risk? Are you seeing that?
Well, what I'm seeing a lot of is people in their 60s coming in here with a portfolio that has almost 65, 70% in stocks. And, they have a little bit in bonds, but, they've had style drift where, they meant to have maybe a 60-40 split, but the market's been so hot that it's flipped around on them and they haven't, rebalanced it. And that's something that needs to be concerning.
What if, Tim, a listener's out there and they're saying, well, I look at my portfolio, I don't own stocks, I own mutual funds. Is that the same thing?
Yeah. Well, yeah, I mean, it definitely. And in mutual funds, 80 cents on a dollar cannot go to cash. So last March, I'm sure every one of those money managers wanted to run to the exits. But at the end of the day, they can't do that. The Investment Company Act of 1940 created mutual funds, and they cannot go to cash. And that's in our book. 20 cents on a dollar can go to cash. Now, people say, well, if I want to go to cash, yeah, if you make the phone call and tell your advisor or your mutual fund company that you want to go to cash, that is a whole different ball of wax. But I'm saying the money manager of the mutual fund cannot do that. So only 20 cents on a dollar. And that's concerning to me. You can't put a stop loss on something like that, So how do you do that? Well, in our portfolio, we have a daily stop loss. Is it perfect? Of course not. But it does go to cash when the market slides down. And we did that last March. And, the proof is in the performance.
Well, if you would like to see what that would look like, the kind of difference that could make in your sense of financial confidence and well-being, regardless of what the future holds for us in the market, pick up the phone, give Tim Stearns a call, request the time for that Protect and Grow plan to be put together and designed for you. 800-640-2256. That's 800-640-2256. But Tim, I think you could agree, while the last decade, 12 years or so, has been fantastic in the market, not every decade is going to be like that. And I don't know how much we can realistically expect the decade in front of us to come to look like the decade that we've just been through here.
Right. And I think it's given us very unrealistic expectations that, no matter what, the market's going to go up the next day. That is not the way the market works. About every 7 years, there's a pullback, and we haven't had one in 12. So that scares me.
And those pullbacks, Tim, they're not just 5% declines. Those are serious drawdowns on average over the last 100 years or so. They have been in the range of 35 to 40% for those downturns and those drawdowns. So I don't think that the average retiree wants to see 3 or 4 30 to 40% losses of their portfolio value over retirement. And that's, again, why having some mechanisms in place to prevent those big catastrophic losses are so important. And if you don't have those in your portfolio, if you're not sure if you have those kind of protections in place, pick up the phone again, talk with a certified financial planner. Tim Stearns here, available to have those conversations with you, ladies and gentlemen. 800-640-2256. You started that, Tim, by talking about quantitative easing and these stimulus measures, all of the money that's been pumped into the economy. That's another pretty hot topic right now. And, many across the country needed some help and assistance. But the first round of quantitative easing after the Great Recession, that was money that was just kind of pumped back into the government. But nonetheless, money that was created kind of out of thin air. Now, I went to the FRED, it's Federal Reserve Economic Data, and I looked at this chart, and it was pretty scary. It showed that 20% of all of the money currently in circulation has been put in circulation within just the last 12 months.
Right.
Why is that something to note and to be concerned about, Tim?
Well, what it's going to do is it's going to lead to the silent thief having a very good time, and that is inflation. And that's one of the things that we worry about with our clients. And so when we do income allocation plans, we make sure that we take into effect inflation. We explain to people that your dollar needs to double every 22 years. And one of the examples that we give is that in our office here, we have the Sears catalog from 1976. In 1976, you could put 4 tires on a car for $200. My son needed new tires this past about 3 months ago, and we bought them, and they were $800 for four tires installed. So there you go. That is a great example of what inflation does to the dollar. So every 22 years, your money needs to double.
Inflation, another pretty hot topic right now.
Absolutely.
We're in the throes of it, Tim. We're seeing this. The reality of inflation is actually hitting us day after day, month after month here in relatively recent history. Anyone who's gone to the grocery store understands that, especially if you're building a home or shopping in the housing market. Tim, inflation is real, and in our planning, it is something that we have to address and account for.
Well, one of my friends has been trying to build a house, and lumber prices have tripled on him, and he's been holding off because he doesn't know what to do. Him and his architect are like, when does this thing come back down to earth? And will it ever? Is this the new normal? Because there's a backlog. So these are things that are affecting normal, Americans daily. So we have to, in retirement, make sure that we don't let that affect us, by taking into effect that there is going to be inflation. And, if you need $100,000, for example, in your retirement per year, that in 22 years needs to be $200,000. That's a fact. Otherwise you will be, you won't be able to pay all your bills. And don't tell me for a second, Social Security is going to keep up with that.
Right.
The cost of living adjustments they give us are, they're nice, but they're not going to keep up with inflation.
Well, that's another hot topic here, Tim, because Social Security has for years been telling us that they are underfunded and might need to reduce benefits in the future. It's printed right there in bold on the front cover, and then again on the inside of any statement that you get, or if you go online to ssa.gov and pull your account statement, they state it twice. It's in bold print that the exact amount in the year has changed. It's come sooner and sooner, it seems, but they say in 2033 or in 2032, they're going to be forced to only pay out about 77 or 75 cents on the dollar. Now, Tim, the Social Security statement itself just kind of got revamped. They've got a new look to them. If anybody goes and pulls their statements now, and that language has changed slightly. It says that, hey, Congress can change the laws and the rules on Social Security at any time. Is that of concern when you hear that and you read it right there in the statement?
The analogy we like to use in our retirement classes is that someone moved the cheese in the maze. It's a little bit further now, maybe, or maybe it's a little closer, but usually it's going to be a little bit farther. And so those are definitely concerning. You're not working in the know there. You don't know. You're up to the whims of Washington, D.C. And I don't care what party's in charge there. you never know what's going to happen. And things happen, slowly, but when they do, they could be catastrophic for Americans that are in retirement.
Tim, when you're helping a saver or investor, a retirement-minded individual, and you're designing that protect and grow plan, and you have those conversations about Social Security, and there is the concern there that, hey, I don't know how reliable this is. How do you address that question? What are the conversations that you have?
Well, I mean, we make sure that we've set them up with other income that, if somehow Social Security gets cut back a little bit, we were able to shore up the ends and make sure that they're able to pay their bills. So, and that has a lot to do with the growth bucket that we've created for people. We don't assume a huge return in it because we just want to make sure that we're slow and steady wins the race type of thing. We want to be the tortoise, not the hare. And, the market right now to me reminds me of the hare. It's easy come, easy go, as my father used to say.
Well, again, ladies and gentlemen, if that sounds like what your thoughts are, kind of matches your mentality and your thoughts on how you would like your plan, your financial future to be structured, the premise that it should be based on, pick up the phone and get the help and assistance of a certified financial planner in actually constructing that plan with those thoughts in mind. That's what the Protect and Grow plan is all about. And Tim will help you put that together, analyze the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, inflation, healthcare, how to create income from your portfolio. All of those are topics that are addressed within and encompassed by that Protect and Grow plan. And it's no cost, no obligation. Similar plans with the help of a certified financial planner easily can go upwards of $1,000 to several thousands, some cases tens of thousands of dollars. But Tim Stearns does not charge for putting that plan together. If you decide to move forward and work on that plan together with him and implement that, you can talk about any kind of cost or compensation and gauge whether you believe that it will show you mutual benefit. It's the cost and the value of that plan, but you've got the plan in your hands to evaluate that. And if that sounds like a great opportunity to you, pick up the phone now to take advantage. 800-640-2256. That's 800-640-2256. Tim, in addition to just the generic white hot stock market, we're hearing about a handful of stocks in particular, an awful lot in the news. And these have been dubbed these meme stocks, GameStop and AMC, and things that it seems like people are just making money hand over fist and kind of printing it for free. But in actuality, a lot of people lost a lot of money in these as well, and in cryptocurrencies. Can you address maybe these meme stocks and what we're hearing about cryptocurrencies right now, and where, if any, they play a role in our current planning?
Sure. Let's start with the meme stocks. To me, that a little scary because a lot of that had to do with short sellers, people who believed that the market that the stock would actually go down. And then they actually started to rebound because, people were being able to go see, for example, movies again with AMC. So it started to go back up. Well, those short sellers have to cover their, the short sale position that they had. And then what happens is it's just a snowball going up in a good way, but overvalued. So those are the things that the flashes in the pan, we don't do that, and then I'll relate that also to cryptocurrency. My middle son always wants me to get into that. And I guess I'm a little bit like Warren Buffett, not as wealthy, obviously, but with his mentality that if you can't understand it, don't invest in it. And we've never invested any of our clients into that. Are we behind the times? Sure, maybe we are, but I like slow and steady and, stable. And if I'm in retirement, I'm not going to play games with cryptocurrencies and that type of thing, or if I'm getting ready to retire.
Well, I think that we also have a tendency to always hear the good stories. Yeah, somebody invested $5 in cryptocurrencies and Bitcoin, and it went all the way up to $60,000. But there's just as many people, if not more, Tim, that invested when Bitcoin was at $64,000 and then subsequently lost half of their money when it fell to $30,000 and $32,000. So It's just it's the side of the story that you hear versus the side of the story, unfortunately, that we don't hear on those things. Right. And that's what I think skews how attractive it is to maybe foray and venture into and risk some of your money by investing in any of those things. But thank you for your take on those and your approach to them. Certainly, again, a white hot topic in the financial world we're hearing a lot about right now. Tim, maybe one that we should be hearing about, we're not hearing as much about it as maybe we should, yet still a hot topic: sequence of returns or sequence of returns risk. Tell us what this is and why we're maybe not hearing as much about it as we should.
Well, sequence of returns risk is it's when the market is, if you're going to retire and the market is bullish and it's going up, the sequence of returns risk will work in your favor. Okay. But if you go to retire in what's going to be a bear market, it can make your retirement really hard. And what I find in our retirement classes that we teach at the colleges around here, I'd say 90% of people don't have a clue what that is. So again, it's take advantage of the rising markets. That's sequence of returns risk, but then be leery of the downturns, because that is what's going to ruin or make a retirement not as successful. The first couple of years of your retirement are going to set the tone as to how the rest is going to be. So if and we show an example, we nicknamed them Bill and Jill, and Bill retired at the right time and into a bull market. He did very, very well. His sister Jill retired into a bear market in 1999. She retires. She goes through 0, 0, 0, 0, 1, and 0, 2, which is about negative 50%, which is terrible. And then guess what? 2007 through 2009, negative 50%. Again, over those 3 years. So when I sit down with people and I look at that they have 70, 80% in stocks, and they're in their 60s, I ask them, are you prepared to lose 50%? Well, no. Well, you've just done that twice in the past 20 years. And, this is, again, using asset allocation for people. And that's why we don't use that. We don't subscribe.
Well, and a lot of asset allocation plans or projections for retirement, Tim, sort of assume that we're going to make an average rate of return, but it's not an average. They show it as though it's a steady, consistent rate of return. And so the scenario looks fantastic. But in actuality, if you throw just a few down times and bad years into that scenario, especially early on, it negatively impacts the rest of the duration of that plan. And I think at its core, that's what sequence of returns risk is, and why we need to be concerned about it. Because if our plan is relying on no negative years happening, and then one does, especially early in our retirement, it can be devastating. It can be catastrophic. It can at least affect our financial confidence for all of the years to come thereafter.
Right. So one of the things when we're meeting with people is we make sure that they understand that we're doing an income allocation plan. And they'll say, well, you know what? I did something like this with my other advisor. All they are illustrations that project 8, 9, maybe even 10% of returns going forward. And to your point, that does not happen. The market doesn't always go linear upscale. I wish it did. That'd make my job a lot easier, but that's not a thing. And people have to realize the past 12 years has been fantasy. Especially this past year. Why is the market up? Nothing is back to normal per se. People are starting to open up things and that type of thing, and that's great. I'm very happy for that. But, the price of lumber is triple what it should be. Things like that, that's not normal. So people need to realize that, when you're going into retirement, that, again, to your point, the market is not always going to go up. That's not a thing.
Well, ladies and gentlemen, these are the factors that Tim Stearns, as a certified financial planner looking out for your future and your best interest, actually includes in the plans that he puts together. Many of these factors that we've talked about are not included in traditional plans and projections and hypothetical illustrated scenarios for retirement. That's why you need to seek the guidance of a qualified, experienced professional like Tim Stearns, because you don't want Murphy's Law to hit you when you're in retirement and can't do anything about it. So take that approach during the planning process and be prepared for it in your financial future. That's what the Protect and Grow plan is all about. And if you'd like to get that Protect and Grow plan put together for your situation, pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Or you can go online, request the time from tjstearns.com, tjstearns.com, the website to go to, or 800-640-2256. Tim, the last topic that I think we're going to have time for on this segment of the program, taxes. We're hearing a lot about taxes. What do we need to do about them?
Well, number one, you have to pay them so you don't go to jail. But I'm just kidding. Basically, no one knows what's going to happen for taxes going in the future. I mean, it's the great unknown, right? But they've talked about moving them up, and they're the lowest they've been in 80 years. So I would think that that's going to happen. The thing that I ask people out there is to remember two things. Number one, when they raised taxes during President Clinton's era, they did it retro back to January 1st. Okay. So, and with President Obama, when they raised taxes, they did it as of the next year. So is right now the time for maybe doing a Roth conversion? Because you hope that Biden and those guys will actually do it so that it's the next year that they would start this process. That would be nice because, again, taxes are the lowest they've been. So right now, a Roth conversion might be the time, the timing for that. That would be well. We don't know what's going to happen, but I will tell you this. When I'm in class with people, I ask them, where do you think taxes are going? And I don't care their political affiliation. They all raise their thumb up.
Fingers
right?
pointing up. Yeah.
Going north. So that's a real thing. And right now is maybe an opportunity, and you should talk to your advisor. And if he or she hasn't talked to you about that, come talk to us, because we have a CPA here. We can quantify exactly what a Roth conversion is going to look like.
Yeah. And not to slight anyone, but Tim, excellent point there. If your advisor has not spoken with you about any of these issues or concerns that you have, it may be an indication that you're missing other things in your planning as well. That's where the time, the experience, the perspective of a certified financial planner can benefit you. So you're not worried about what your plan doesn't address. And if you'd like to get that plan put together, that Protect and Grow plan for your financial future in retirement, including that income allocation, pick up the phone and give a call now, 800-640-2256, 800-640-2256. Tim, in this short program, time always moves by very quickly. I think you did a great job of hitting on a number of the hot topics that people are hearing about and talking about across the financial world. And we've got more knowledge and understanding from sharing in a little bit of your guidance and perspective. So thank you for being here and having these discussions each week on Protect and Grow, Tim.
Well, Peter, thanks for having me.
Ladies and gentlemen, procrastination is not your friend. It is certainly not proactive or progress. So pick up the phone now, be proactive, get that Protect and Grow plan put together. Give Tim Stearns a call. He's looking forward to hearing from you, helping in any way he can. Even if it's just providing that book. If you've got over $500,000 saved for your retirement, you need to understand the risks that you'll face in your financial future. The essential retirement planning strategy guidebook is Income Allocation. Tim makes that available to the first 10 callers on each program each week. So if you've got $500,000 saved for your retirement, this book is important for you to read. Pick up the phone right now and give a call and request Income Allocation, 800-640-2256. That's 800-640-2256. Again, Tim, thank you for your time. We'll talk to you soon on Protect and Grow.
Yeah.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.